which you also called FA. And another one is your paper MA, which is called Management Accounting. Previously, we used to call it ACCA F2. Now, financial accounting is significantly different than the management accounting. And now let's see what are the differences. So this is financial accounting and management accounting. I just made one slide for comparison. First thing is that financial accounting, it is a legal requirement, which means that all businesses, they are legally required to prepare their financial statements, to prepare their financial accounts, which are submitted to different authorities. So financial accounting, it is a legal requirement. On the other hand, management accounting, it is not a legal requirement, which means that a business, it is its own choice whether they want to do management accounting or not. So nobody would ask you to prepare your management accounts or submit your management accounts. It is totally up to the choice of a business. So usually in large businesses, we do have management accounting. In small businesses, actually financial accounting department, they perform the duties of management accounting as well. But if you see large scale organizations, you have separate team for doing or performing the management accounting activities. Second is that there are 5 financial statements like income statement, balance sheet, statement of cash flow, statement of changes in equity, and notes to the financial statement. So only 5 statements. We don't have 4 or we don't have 6. We've got 5 financial statements according to IFRS. And these financial statements, they have a legal format. So IFRS has very clearly told you that how should an income statement look like, what is the structure of income statement, which elements would appear in income statement, and then similarly about balance sheet, that how should a balance sheet would be presented, what is the structure and format of the balance sheet, and what are the components and how they should be shown in the balance sheet. So it is a legal format and you have to follow that. You cannot make income statement or balance sheet with your own choice. So that is not possible. But if we see management accounting, in management accounting, you also prepare different reports. You do not call them statements, but you call them reports. And these reports, it is your own choice. Whatever format which is suitable for you or whatever is more appropriate for your own business. And additionally, you should know that in management report, there is no number of reports that there should be 5 or 6. There could be 5 reports, there could be 10 reports, there could be 100 reports. It all depends on a business and the managers and their requirement. We call it management accounting. Management accounting means the accounting which is done for the managers, the accounting which is done for the management for their own analytical and decision-making purposes. So it is their choice how many reports they want to have and what format they would require. Then we say that financial accounting statements, they are prepared on historical data. Historical data means that the transactions which have already taken place. So any financial transaction or activity which has already taken place, you consider that only and prepare your financial accounting. So throughout the year, you collect information and based on that information, you prepare financial accounting data. In financial accounting reports, you do not use future transactions or you do not consider future data. Whereas management accounting, it is futuristic in nature. So management accountants, they do not collect the information, they do not make debit credits, they do not do any recording of transactions. Management accountants, what do? They take the data from the financial accountants and based on that data, they prepare their future forecasting or analytical or whatever they do. So management accounting is more of looking into the future, financial accounting is looking into the past. So what I would say that financial accountants, they have a very restricted role. If I have a financial accountant and he comes in and he says that, what am I supposed to do? So I say, you sit down here, you record the transactions and end of the month, you will give me income statement and balance sheet, etc., whatever. But if a management accountant comes in and says, what is my job description? I cannot define it. I say that you stay with me and you help me in doing whatever I do, because every day I have to take a different decision, and every day in order to make that certain decisions, I need information, and that information would be provided by the management accountants. So management accountants do not have a very specific role. They have a very broad spectrum. Financial accounting statements, they show the financial performance of a business. And that financial performance of the business is actually visible to the outsiders. You can present it to the outsiders. Management accountants, they analyze the present forecast. So financial accountants, they are not about why a business is doing good or business is doing bad. Financial accountant will show you the actual picture, whatever it is. Whether you are making profit or you are making loss, you will just prepare the financial statements, and financial accountant is not concerned if we are making profitability or not. However, the management accountant, he will take the financial statements from the financial accounting department and he will do his analysis that if we are doing good or not, how good are we doing, and if we are not performing well, what are the reasons or what could be the reasons for the bad performance. And then he also has to suggest some corrective measures for the future performance. Financial accounting statements, they can be presented to external parties, yes. Financial for large scale companies which are quoted and listed companies, even the financial statements, you put them on your website so that everybody can have a look, even you are not related, but future investors, potential investors, public at large, everybody wants to see and everybody can see. So financial statements can be presented to external parties. Whereas the management accounts, they are purely for internal purposes. They are for the management. So you do not show your management accounting to outsiders. Management accounting is purely for internal purposes. Financial accounting, financial statements, you show it to your customers, your suppliers, the government agencies, tax authorities, bankers, lenders, creditors, investors, future investors. Everybody can have a look at that. Financial statements include what? They include your income statement, which is called also statement of comprehensive income, statement of financial position, which is called balance sheet, statement of cash flow, and statement of changes in equity, and notes to the financial statement. So these are the 5 financial statements according to IFRS. There is no 6th one, only 5 of them. And management accounting, I did not use the word financial statement. I did not use the word management accounting statements. I said examples of activities or reports. What do? They do costing reports. So management accountants, they calculate the cost of making one product, one unit of the product. They calculate the cost of one process. They calculate the cost of one department, and ultimately they calculate the cost of doing entire business. So they are related to the costing. A big part of management accounting is focusing on the costing aspect of a business. Then they prepare the budgets. So budgets are prepared by the management accountants because budgets are futuristic. Budget you prepare for the next year. So budgets are not prepared by the financial accountants. They are prepared by the management accountants. And they do forecasting for the planning purposes. They do profit planning. So they plan how much profit are you going to make in the next year. Financial accountants do not prepare. So financial accountants, they prepare financial statements at the end of the year. So on 31st of December. But management accountants, they prepare forecast financial statements at the beginning of the year. So even when you are starting your next year, on 1st January, you do prepare your income statement and balance sheet, which is called forecast income statement. That how much are we going to make the revenue in next year, what is our plan, what is the expected profit. Because when you start a year, you do not start it just by on your luck and see how much profit you will make in the end. You want to see that if I do or if I perform this certain set of activities, how much will be my profit at the end of the year. You want to know it in the beginning. You want to know it in advance so that you know what exactly you are chasing for. And management accountants, they prepare this forecast financial statements at the beginning of the year. And performance measurement. And throughout the year, now you've got 2 things. One is your budgeted performance, your forecast performance, your forecast financial statement, that next year we are going to do a $10 million in revenue. So this is your forecast. But then this is prepared by the management accountants. But then you have financial accountants. They are preparing actual results on monthly basis. So what you do, you take from the financial accounting the actual results, and then you have your planned activities, your forecast results in your hand from the management accountant, and you compare that how good or bad you are doing as compared to your plan. So your plan was, say, $1 million sales per month. This was your budget, this was your forecast, this was your plan, which was prepared by the management accountant. But then you see from the financial accounting department the actual information that are we really doing $1 million or not. So if you are not doing $1 million as against your target, then you need to take some corrective actions. So this is how these two, financial and management accounting departments, they go hand in hand. Financial accountant, it talks about reality, it talks about, you know, the actual numbers which have already taken place. Management accounting is more about futuristic, it is more about planning, budgeting, forecasting, analysis, and it is showing you the direction for the future. So this is all about financial and management accounting. Management accounting is very wide spectrum, very wide scope. So financial accounting has somewhat a narrow scope, whereas management accounting has a very wide scope. There was one last topic which I wanted to discuss, that was about governance. Actually, this topic is a very huge topic. You use the word corporate governance. Corporate governance means the method or the way in which organizations are managed and run. This is your this will be discussed in your paper, which is SBL, Strategic Business Leader, which will be your 10th or 11th paper in ACCA. And right now in F3 it is not discussed in a lot of detail. We just touch it, we just draw a tangent and move on. So governance means the the way you run the business, the way you govern the business, you manage the business. And we know that businesses are run by the directors. So we will only talk or speak here a little bit about the directors. So who are the directors? Directors are the managers of the business. Directors are appointed by the shareholders. Their job is to run the business. Their job is to manage the business on behalf of the shareholders. You have got HR director, marketing director, finance director, or probably, sales director. And above all of these directors, you have got managing director, which is also called CEO. So what is the director's responsibilities? Directors are stewards. Directors are caretakers. They have been trusted by the shareholders. Shareholders have given them the authority and responsibility to run the business. So their main aim of directors is to create wealth for the shareholders and to protect the assets. So this is their main aim, because this is what they have been trusted with, to protect the assets of the business and to create wealth for shareholders. They have a duty of care to show reasonable competence, may have to indemnify the company against loss caused by their negligence. So if the directors, they are being careless and they are being negligent in running the business on behalf of shareholders, and because of their carelessness or negligence, the shareholders or the company faces any loss, it is also possible that by legally you can bound them to compensate. They have to indemnify the company. So it's a very responsible position. And they are in a fiduciary position. Fiduciary means the legal position in relation to the company, which means that they must act honestly in what they consider to be the best interest of the company and in good faith. So it's again the same thing, that in good faith, and they have to act honestly. And if there is any situation of conflict of interest where the director's interest and company's interest, they are in contradiction or in conflict with each other, the directors should give priority to the company's interest, and they have to compromise on their own personal interest. And they are responsible for the preparation of the financial statements of the company. This is very important concept. Many people, they think sometimes that finance manager or chief accountant or finance director, they are making financial statement. Yes, they are making, but they are not responsible. Actually, directors are responsible for making financial statements, but because the directors do not have enough time or capability or competence to make financial statements, they hire finance managers or accountants to do that job on their behalf. So they have given their job to someone else, but it does not relieve them from their responsibility. The ultimate responsibility, it lies with the directors, not with the auditors, not with the finance manager or chief accountant. Actually, if you see these 4 points which we have mentioned, it is a very big possibility that there could be one of them will be checked in exam. So you should remember that directors have a responsibility of preparing financial statements. The directors, they have a responsibility to act honestly in the best interest of the business and with good faith, and they have to exert the duty of care. Otherwise, they have to indemnify the company. So this is, I would say that is the end of your chapter number 1. Surely there are no mathematical or numerical topics in it. It's all theoretical chapter. You need to read the theory by yourself. You have to do practice questions. I have already uploaded one video within this section in which we did some questions together. Okay, in your practice kit, there are not any questions given from this particular chapter. So I'm not uploading any questions within this section. Yes, in chapter number 2, we have some practice questions, and within chapter number 2, the practice questions which we will do, some of them, they do belong to chapter number 1 as well, but there are not many questions, especially from chapter number 1.